You're tuned into The Air We Breathe, a conversation on how we can fight climate change and sustain a cleaner environment with Bennie Lee Williams and Lori Collins right here on Watch LOTUS X.
Okay. Well, great to see you, Bennie.
Yes, it's good to see you.
Yeah.
And we have risk management to discuss today, as far as global and climate analysts
Well,
go.
it is a great time to talk about risk management because last week was London Climate Week.
Mm,
And of course, I didn't go, and I don't think they had in-person meetings anyway, but they had a lot of webinars and a lot of, several people that I knew were on panels. And so there were live discussions, you could ask questions. And I heard some great speakers. So there were a lot of international finance organizations, but the ones that I think are most exciting to hear from are BlackRock, largest investor,
right.
Macquarie Capital, which is
Hmm.
is an Australian company, and it's the largest infrastructure investor in the world.
Oh, wow.
Yeah, and then Moody's Analytics, and we've talked about
Right.
Moody's and the impact on bond ratings. So here you have, the largest equity investor, a major bond ratings company, and largest infrastructure investor in the world. And so I was able to get hot off the press insights into
Wow.
how these thinkers are managing climate risk.
Okay.
So it's perfect timing. I have some good
This,
things to share.
yes, I'm all tuned in. I have my notes ready.
Right. Well, and so do I. So one of the big ideas is that there is a lot of value, obviously, in managing risk. And BlackRock has said climate risk is investment risk.
Mm,
So the big investors are taking it very seriously and see it as directly relevant to their investments and the value of those investments long term,
hmm.
which is very exciting. And the challenge that these various investors, whether it's bonds or infrastructure or equities, their challenge is how do we integrate climate risk into our regular decision making so that it's not an afterthought, it's not a sidebar, it's fully integrated. And it's not figured out yet. That's another headline. They do not have the secret sauce figured out. That's
Mm,
why they're having these conference calls. They feel like there's a lot of room for financial innovation. But there were some ideas and concepts that I thought were maybe not exactly what I expected to hear. So I'm excited to be able to share that with you.
okay.
One comment I heard from BlackRock that I thought was a great way to phrase the issues with climate risk and why it's so important for investors to take it seriously is that climate risk, and I'm gonna get this exactly right, so I may read it. Climate
Okay.
risk will result in the reallocation of assets faster than climate change will actually occur because markets bring risk forward.
That,
Did you want
yeah,
me to? So that is a lot to think about.
yeah, it is.
So
Almost,
essentially,
can you just say it one more time, if you don't
sure,
mind?
climate risk will result in reallocation of assets faster than climate change actually occurs
Mm,
because markets bring risk forward. So I'll unpack that a little bit.
okay.
When we say climate risk will result in reallocation of assets, what does that mean? That means that an investor will decide, I'm going to get out of this asset and move over here.
Mm,
That could be saying, I want to stay in this space. I want to stay in technology. I want to stay in agribusiness. I want to stay in retail. But I'm going to pick the winners within those sectors.
mhm,
So that could be one reallocation of assets. Or it could mean I'm getting out of this sector completely.
mm,
I don't have time to drill down into every real estate investment trust and figure out where the risk is in real estate. I'm getting out of that whole asset class. Now that would be, a bigger decision and it would it would be impacted by more than just climate. But that's what it means. Reallocation of assets is that I'm going to get out of whole sectors, or I'm going to pick the winners and losers in that sector. I'm going to pick, it could mean I'm going to get out of certain geographies altogether.
Right.
I don't feel like I can get a handle on the risk in Indonesia or Miami. I'm getting out of those markets. Whatever it means that's relevant for that particular investor, that's reallocation of assets. They're going to go ahead and make decisions. They're not going to wait for the risk to happen. So that's the other piece of the concept, is that markets bring risk forward.
Right.
An investor is not going to wait until the disaster happens. That's the whole point of trying to be a good investor, is to assess and look at potential risk and position yourself to take advantage of opportunities or avoid certain risks. So they're not waiting for it to happen. And if they think it's going to happen, they may go ahead and make some decisions. If they don't feel like they can get their head around it and are not sure, they're going to get out of that asset. So I thought that was and that came from BlackRock. That I think is a really good assessment on why investors are taking climate risk seriously and figuring it out now. They're not waiting. Right. Whereas in some other parts of the world, or if you're in retail or if you're in media, you're not necessarily worried about climate risk right now. It's not that relevant to what you're doing, so you're not thinking about it. But if you're an investor, you want to be ahead of the risk. So that I thought was really interesting. There was another comment that everyone on the phone agreed with, and I listened to 3 different panel discussions. So this is over the course of 3 different, 3 hours worth of discussion. And another concept that came out that was surprising is that data is not the issue in climate risk management. So in some other of our discussions, we talked a lot about climate risk data, and that the new climate data companies are coming up. And I know that they're valued because one of the climate data companies just got acquired by Moody's.
Right.
But the consensus was, there's so much data. There's data companies popping up all over the place. We have more than enough data. That's not our main issue right now. And I think these climate data companies still have a lot of potential, but there's almost too much data. If they know, every single facility of every single company and whether or not it's at risk, it's just
right. What do you start to do with the numbers then?
How do you make it useful?
Right.
How do you make it relevant? How do you make it useful? What is the source of the data? What's the quality of the data? You may have in your records that a company has a major manufacturing plant in Jakarta, and so you take that into consideration. Well, what you don't know is they realize they need to move that, and they're working on it, and they've already moved the manufacturing facility by the time you can be impacted. Right. So there's a sense that all of this data is, sort of enough already. And that also the investors don't have time to wait for perfect data. They see that climate change is impacting their investments right now, or in a time frame that they need to be moving on it now. They need to get themselves, the investors want to get in position to not be in harm's way. So they feel like they just can't wait for perfect data. And they are looking at it. They're working with these data companies and they are modeling it, but they don't feel like that's the panacea.
Okay.
And this was the general consensus of the investors on these London Climate Week panels. It's not the panacea. Yes, it's still useful. Yes, they'll still look at it.
Right.
So what do you think was their alternative?
I've been thinking the whole time. Well, at first it was okay. If the data isn't something that makes them go, it doesn't have to be perfect. It still has to come down to the management of what is it looking like, the management, what is that group looking like that's operating it. So I guess that's my that's my next
Right. So
concern
you're
is
looking at do you feel confident in the manager's ability to take
right,
advantage?
right.
Well, actually, that is a good point. Uh, and that's going to be incorporated, I think. And the big idea was scenario analysis.
Okay.
That rather than try to be so precise and get actual precise data and know exactly when this particular company may be impacted and when's the risk going to happen and where is it going to
Right.
happen and how much of their business is it going to wipe out, it's just not realistic to get that precise.
Okay.
So the big idea was to use scenario analysis and to run a number of scenarios, and potentially longer time horizons than companies typically use. And, a lot of companies, if they are publicly traded, tend to be very short-sighted. They're always thinking about quarterly earnings.
Right.
It's hard for companies to think out longer. So to use longer time horizons than they might typically use, and to use localized data instead of averages. So a lot of the climate data around the weather events and the climate events tends to be broad data. So
Right.
to be as localized as possible when evaluating different investments, and to take a systems view. That was another big argument for looking at scenario analysis instead of
Okay.
just very data driven. In a scenario, you can look at a whole system. You can look at the
Very true.
natural infrastructure. You can look at communities. You can look at the readiness for that particular market. What is their government doing? What are the businesses in that market doing? And there was actually a lot of interest in nature-based solutions, which is everything from planting more trees to just to having more fortified waterways and overall natural solutions, whether different buffers, that type of thing. And so that was the suggestion, or the big idea, is to look more at scenario analysis and to be sure to include a scenario on doing nothing, and not to underestimate the risk of doing nothing. Because you may find that when you have a let's call it base case of doing nothing, you could have several different scenarios and they're
Right.
all better than doing nothing.
Yeah.
And then that tells you, again, you don't have to be so precise. You don't have to be
Right.
perfect. Do something. Any
Yes.
one of these scenarios is better than
Right.
sitting still. And so
And
I
it,
like that. And it's actually very relevant
right.
because you look at North Carolina. North Carolina is trying to grapple with a resiliency strategy. And North Carolina, UNC Charlotte is working with Duke Energy on a number of resiliency strategies and getting great data from Duke Energy. But I think I'm so excited to take this information back to the folks that are looking at this, because it's a great insight that, yes, get as much data as you can, but you're never going to have perfect data. And even in any data you get is going to be historical. So what about the go forward? You're trying to project the future, and nobody can really project the future. It's not going to look, it's not going to be on a trend line. So yes, take that into account, but then use your imagination and use global projections, use what we know about North Carolina's resiliency strategy, and based on that, develop a number of scenarios. It is a
Yeah.
different way of thinking, and
Yeah, it makes sense though, because even now as I think about how we've gone along this flow, even coming off strategy, if you're coming up with a strategy, you would create some kind of scenario, because as you create strategies, you think about, okay, what if this happens? Then what if this happens? So I guess it does play a part in that. So
right.
yeah.
And you can have strategies based on different key drivers. You can say, well, for this strategy, we want the key driver to be maybe a political trajectory. For this strategy, we want the key driver to be whether or not the Atlantic Coast Pipeline goes forward, which apparently it's not going to go forward.
Right.
Or you could think about just take a step back from all this data to think what are the key drivers in this industry. Say that you're just bringing it down to one company that's developing some scenarios, or one state, or one investment group. You can determine what the drivers are that are most relevant, and then use that as the focal point for these various scenarios. And it's a great way, I believe, of approaching it. And I'm excited to be able to share that with some of the people I'm working with as a different way of thinking about. Yeah. So that was one of the main themes from London Climate Week.
Wow.
And then, so that is a little bit more focused on equities. We've also talked about municipal climate risk. So that has more to do with the bond market. When you're looking at cities, counties, states that are issuing municipal debt, and how might their climate risk impact their bond ratings, which impacts their access to capital and cost of capital. So I was able to ask a question about that, actually.
Oh, okay.
So that's one of the benefits of being on Zoom. I don't have to go to London to participate in London Climate. So I was excited about that. So the question in the municipal bond market, this is what I learned on these.
And this is the question you asked, right?
This is a question I asked.
Okay.
Well, I asked about how do you work with cities and states to help them think about their climate risk.
Right.
And what came back was that the potential for downgrading credit is that's not an immediate concern, which I was happy to hear. That's not shouldn't be immediate concern. That's not the main objective of the bond rating agencies. When they're looking at a municipality, city, state, it could be a nation, but generally city or state, they're looking at how well equipped that municipality is to deal with climate risk. So they're more interested in trying to understand how well equipped they are, and potentially sort of guide this municipality towards a more resiliency, not as a punitive action to downgrade their credit or impact their cost of capital, but just to get a sense for how this municipality could be better equipped, and to help guide them. And it's a little bit what we talked about with the insurance companies helping drive adoption of best practices. And the bond rating agencies can do the same thing. And I think that's a real force for good in a way that is going to motivate a municipality, because everybody you don't want to pay more for your mortgage interest than you have to, or you don't want to pay more for your municipal bond than you have to. So that was encouraging. And just the whole idea of how they evaluate a company's readiness. And so that gets a little bit more into the opportunity side. We're talking mainly about risk, but the opportunity side is how a municipality or any company can invest in resiliency so that they are more prepared for the risk. They are positioning themselves to maintain a strong credit rating.
Right.
And this was interesting to me. They talked about resiliency versus adaptability, because those two terms get interchanged a lot.
Okay.
And in this conversation, it was defined as resiliency pertains more to your existing infrastructure. Right. How are you making your existing buildings, your existing infrastructure more resilient? And adaptability was referred to more as new buildings, as you're developing new infrastructure, developing or building new state buildings, or if it's a private company, any kind of manufacturing, create it for the purpose of climate resilience. And that was how they defined adaptability. And that gets into the opportunity side, that as companies are looking to justify investments, whether it's upfitting an existing building or creating new infrastructure, the more they can tie it to the need to maintain a strong credit rating, it helps justify those investments.
Now, let me ask you a question. this was at this event. When was this exactly? When
Last week. So it was
last
July 1st, July 2nd, and July 3rd.
Okay.
It's in London. They don't have
Right.
this day.
When you were listening to this call and you have these investors speaking as well, right?
Yes.
Could you see possibly is this like an alliance?
There were lots of alliances.
Okay. Could you okay.
Yes.
Could you see them forming some kind of continuum of
Yes.
okay.
In fact, all of these, the three that I listened in on, there was a whole week's worth of meetings.
Okay.
The ones that I listened to were part of the Coalition for Climate Resilient Investment.
Okay.
So that was a specific series that I was listening to. And not to just load you up with acronyms, but there were, I could tell you some of the other participants.
Okay.
I thought that I would just to have a sense. I've got it in front of me. So the Lightsmith Group is it's a venture capitalist that is creating the first venture fund focused on climate resilient investing. Wow. They're the first. They've raised their first round of capital, so they're a big leader in this space. They're based in New York. The founder of the Lightsmith Group also founded the Global Adaptation and Resilient Investment Working Group, which is a nonprofit. It goes by the acronym of GARY. Okay. That's a nonprofit that has a focus to catalyze investment in climate resilience. But as a nonprofit, it's focused on engaging investors and really education, outreach, awareness as a nonprofit. Willis Towers Watson, they are actually a major risk management firm. I believe they're based in Miami, but they're a U.S. company. Then the Coalition for Climate Resilient Investment, they are what you were talking about, a group that's pulling people together to have a discussion. The Global Adaptation and Resilient Investment Group, which is a nonprofit, they are also, their mission is to pull people together from all over the world. They pulled together hundreds of investors, insurance companies, family offices, cities. So I've sat right next to someone from the New York City mayor's office that's looking at how to manage water and live with water as a city. There's a group called the Global Environment Facility, Global Commission on Adaptation, the World Resource Institute, which is a think tank essentially, the Global Center on Adaptation. The United Nations has a development program and they have a focus on finance, and the United Nations Environmental Program Finance Initiative. So those are the folks that were on the call and either sponsoring the panels that I listened to or participating.
Wow.
So it's exciting. Yes. There's a lot happening all over the world. There's all these groups some that have different motivations and slightly different missions, but they're working together. Mm-hmm. Some are much more focused on international issues, which, international development, which is basically much more concerned with third world nations and what are all the climate issues there. Mm-hmm. Some are more focused on private capital. So they're all concerned about bringing together and mobilizing capital for climate resilience, mostly climate resilience. Now, some of these are also very concerned with what's called climate mitigation. So climate mitigation, now these are the terms that are used in the industry. Climate mitigation is about reducing carbon emissions. So climate mitigation is focused on energy efficiency, renewable energy, primarily. Also, some things like carbon capture, planting more trees, which is a carbon capture strategy. Okay. But mitigation is the terminology used for reducing emissions. Adaptation is the term used for dealing with what's coming. So they're two very important aspects, but their focus is a little bit different. So adaptation is saying, look, you guys are over there are worrying about reducing climate change. We're going to focus on managing it. It's coming our way. We need to make sure that we have resilient infrastructure and that we've got berms around our rivers, and so we avoid flooding, and we've got fortified buildings and all the things that make you able to withstand, make a nation, a homeowner, a business able to withstand. This set of calls that I listened to and participated in, these panels were focused on the adaptation side.
Okay.
They're looking at how to primarily focus on adaptation. How do we mobilize and motivate investors or public sector to invest in resilience? So if you think about, now I'm going to move into a slightly different topic, but it's related. So if you think about 10 years ago, I mean, certainly 20 years ago, but even 10 years ago, it was still a challenge to get investment in clean energy. Wind farms, solar farms, they were considered very risky. There wasn't a groundswell of understanding on what the business model was, what the payback would be. Was the technology really strong enough? There was a lot still being worked out. And so to boost that industry and prop it up until it could work out, its business model, work out its technology, there was some government support. And there were angel investors that took a lot of chances. And so between the private money, angel investors, very passionate entrepreneurs, and then the government giving some incentives, they kind of propped up that industry until it could get on its own feet. And now it's off and running. There's the clean energy industry is strong. It's creating jobs. It's making money. Tesla is blowing it out the doors, but so it doesn't need it anymore. It's figured itself out, and it's off and running. But now resiliency and adaptation financing is in the same boat. It's not totally clear yet how to attract capital to invest in infrastructure. So if you think you're going to have flooding and you need much bigger water pipes, for example, or you need stronger berms around lower Manhattan, or different types of buildings that are raised, or higher bridges, whatever is necessary to have more resilient infrastructure, where's the payback on that? It's very hard to justify. And so, or it has been hard to justify. And that's what this group of investors all over the world are trying to figure out. How do we motivate capital? How do we build the incentives to motivate capital to put more money into resiliency? And in North Carolina, this is what Duke Energy is struggling with, or grappling with, because what a utility needs right now, and this is most utilities all over the country, or really all over the world, they need to invest in a stronger electric grid. They need a grid that has more underground transmission lines, for example, or they need a grid that has new technologies so that they can better connect to storage and renewable energy. And there's all kinds of automation and being able to have remote sensors. There's a lot of technology that needs to go into the grid, but it's billions of dollars. And that's not how they make money. They make money selling power. So what's the business model for these utilities to go invest billions of dollars into just making their basically making your house more resilient, making it stronger? It's tough. And it's a tough way for them to make money, and they know they need to do it, but they need to figure out how to get paid for it. How do they put all those costs back to the ratepayers? And this gets into the climate justice issues. If you just charge everybody a flat amount and a fixed charge, low-income people end up spending 20% of their income on their utility bill. And no matter how energy efficient they are, they can't get out from underneath it. It's a fixed charge.
Right.
So this is what the industry is grappling with. And that's just an example that's right in our backyard, but just largely, it's something globally that everyone's trying to figure out. All these investors, whether it's BlackRock or Macquarie Capital, which is the largest infrastructure investor in the world based in Australia, or if it's Moody's looking at how do we gauge the credit worthiness of these various municipalities, everybody's trying to figure out how to motivate capital into this area of resilience. So for now, the idea that was laid on the table at London Climate Week at these panels was to have what they're calling blended finance. So when you go into a project, have a mix of renewable energy, which already has a proven payback and a proven business model, and blend that project with some resiliency investment. And then for now, anyway, the renewable energy, or it could be energy efficiency, but that kind of pulls it along, and you blend them together and you get them both done.
Right.
So that's a strategy, or of course, government subsidies is a strategy as long as that can last. So it's very interesting to see some of the best minds in climate finance from all over the world are working together. They're sharing ideas, they're sharing their best thinking to get this figured out. There's not a clear roadmap yet, but I would say the two big ideas that I heard were scenario planning and scenario analysis.
Okay.
And then the blended finance, blending in your more proven business model around clean energy and putting the projects together so that the less proven projects can piggyback and put it all in one project.
Right. That's what actually the blended finance one was the one I was thinking in my head when you were speaking. Because you wanna, if you wanna make more money off a product, then you need to create ways to have that product used more. You know what I'm saying? I.e. the energy. So
right. And then of course everyone is looking to be able to create a model that will help justify the resiliency investments on their own. But just to get some investments done and get them in the market, and like you said, starting to prove their value. This is the strategy for now. There was also an investor on the phone last week, a European investor that had done, I believe he said 8 billion in projects, resiliency projects. Let me just double check that. I believe he said 8 billion euros of projects. Yeah, 8 million. Sorry, big difference there. Million, not billion. But so 8 million euros in projects around climate resilient infrastructure. And that investor is hoping to be able to create some case studies out of those investments.
Wow.
To help other people understand how to approach these investments and that there is a way to get a payback.
Wow. And I had to just so I could understand it. So that's $9 million in regular dollars. When you said 8 million euros.
Sorry, I hadn't translated.
No, it's okay. I had to go ahead and translate that for myself, convert it. So I was like, okay,
right.
now.
So about 9 million worth of climate resilient climate resilient infrastructure investments that this particular group had done in Europe. And they're hoping to pull out of that some case studies. Wow. It probably would take some time to show the payback. So that is what I have to share with you on climate risk. When I realized that the topic was climate risk management, and I just came out of 3 days of very exciting, hot off the press panel discussions with folks from Australia, London, New York, all over the world.
Wow.
Sharing their latest thinking. And it was just Friday, just 2 or 3 days ago.
That's amazing. That's amazing because it's like all these minds in different ideas, suggestions, and experiences too. I'm pretty sure you heard some experiences of what people are doing currently that have succeeded in kind of still works in progress.
Right, sure. A lot is a lot. Well, I think that hearing the investors say data is not the answer.
Mm,
There are
that's
so many data companies, there's so much data.
yeah,
And I don't think that they mean to take away from these climate data companies like 427 or the
right.
Climate Service. They see value in that, but it's not enough right now. It's not the place to hang your hat in the next 12 months for these reasons that I had stated. We can't wait. You can't have that level of precision. And I love the idea of the scenario analysis. It's not
Mhm.
necessarily how companies think. Some of them do,
Right.
but I think that's just a great way to be more holistic and take into consideration the whole ecosystem. And in the meantime, the climate data companies can keep refining their data, and the modeling companies like Moody's Analytics will keep testing it in their models and back testing and working with that data just to see what over time, what makes sense. As far
Right.
as how do they back test, they may find that 2 or 3 pieces of data were the most indicative of results, but it's going to take a while to see that.
And I was going to ask too, wouldn't the data companies, would they not be creating some kind of scenarios as well within their data?
Um,
I,
that's a good point. I think they probably work with individual clients.
okay.
So, say the climate service is working with Aon, big insurance company. They are, I don't know, but it makes sense that the climate service would be working with Aon on a number of different scenarios that
Right.
Aon has. One example that I can share with you is that I may have mentioned this before, that the Nature Conservancy received $1 million from a
Hmm.
big insurance company
Okay.
to test different coastal resiliency strategies. So that in a way is an idea of scenarios. It's a little bit different, I guess, than scenarios, because it's saying go test these
Yeah.
several different solutions and let's see what works. But all of that helps blend into scenarios because the insurance companies can look at coastal flooding, for example, and gauge based on different scenarios how much damage there's going to be.
Right.
With one scenario, if there's absolutely no coastal protection, it could take out entire neighborhoods or take out an entire home. Whereas if you get 50% protection or 20% mitigation of flood damage by having some kind of protective reef, an oyster reef, or marshes, if you only have 20% of the stormwater surge and flooding, then they can evaluate, well, what's that kind of damage going to cost
Mhm.
us? They can tie different risk scenarios directly to an estimated level of financial damage. So they can estimate, well, what kind of claims would I have in these various scenarios? So I know that's happening with the Nature Conservancy in Florida. And I think that's an interesting example of where the finance and the climate risk come together, and
Right.
they're directly correlated to uh, different projections
Hmm.
of financial damage.
Well, it looks like they definitely have their hands on kind of a not a grass, but they're starting to form like a clay of some kind of new way of how this should all kind of work. Like this hasn't been done before.
Right.
So everything is really like this is a beautiful time because everything is you can just throw it at the wall and see.
Right. And that's what companies are doing. I mean,
Yeah.
they are trying a lot of different things. They're not, that was another big takeaway. They're not ready to hunker down and all come around one particular source of data or one particular approach.
Right.
They're sharing ideas. They're saying, we know we need data, but we can't hang our hat on it right now because there's too much data. It's not all transparent. It comes from a lot of different sources. Uh, it's got to be useful. And it's not standardized, and
Mhm.
it may be a while before it gets standardized. I mean, that's in some ways would be the panacea. You think about your credit rating, or your everybody knows what their credit rating is. Everybody knows your FICO score. And so even though there's 2 or 3 different consumer credit agencies, and they all have slightly different ways, basically, if your credit score is 680, it's going to be around 680 at all 3 credit rating agencies. And they've pretty much determined what are the key factors in assessing your credit risk and giving you a score. We're not there yet on climate risk. And that might be the panacea, that we could give each company one specific credit risk rating. That's going to be a ways off. I actually wrote a blog post on that called "What's Your Carbon Karma?" The company Credit Karma. That's
right. I like that.
I wrote a blog post. What's your carbon karma?
I like that. I'm going to go read that.
Right. That was one of the first ones I wrote. It was 2 or 3 years ago. So that's a concept out there. That's maybe a destination. But since we may be a ways away from that, because think about credit risk for consumers has been in the market for a long time. So those credit risk rating agencies for consumers have been able to refine that data and be able to go back and say, you know what? We thought income was the main indication of credit. We're finding out, no, that has nothing to do with it. Or whatever it may be. They've had time to go back and refine their models. And new companies have cropped up that have, say, a different way of evaluating credit for small businesses. They might look at, what is your inventory in your business? That might be an indication of credit risk. Or how much balance do you have on your lines of credit? That might be an indication, more so than your turnover and your sales. So they've had time to evaluate these things and refine and perfect their models. With climate risk, we're a long way from that. And it takes a long time for that risk to show up. So with credit risk, it shows up more quickly. You default, you don't pay your credit card. And it's a manageable risk for the credit agency. With climate risk, it doesn't, it comes like a big burst. There's a big hurricane, or it's really slow, chronic sea level rise. It doesn't happen where 1 month you don't pay your credit risk and you don't pay your credit card and it's manageable. When it happens with climate, it's a big hit. And so it's harder to wait for that data to be able to go and back test the models. That's the ideal, to be able to back test your models. Or the data points that we thought would be most predictive, did it prove out?
What's the results?
Did it prove out that those were the most predictive pieces of data or factors? But we can't wait for that. I mean, over time, 10, 20 years from now, that we may have enough information on what we thought was going to be an indicator of climate risk for a municipality or for a business. But in the meantime, we need another method, and that's the scenario analysis. And that won't be perfect either. But the idea is to have enough information to make the best decision available. What should we invest in? And when I say what should we invest in, how should companies, what types of actions should they take to protect their buildings, to protect their employees, to protect their revenue? What are the best actions for them to take? And that's where the scenario analysis can help make those decisions. Because that's what it boils down to. What are the things, what do you need to do to make your property or your business or your investments most safe? And
you have to protect. And now I'm really interested to see, now as we move forward to metrics and targets, I'm really, after this conversation, to hear, okay, it's not all about the data being perfect. So now I'm interested to see how that influences, and the scenarios may influence, metrics and targets when it comes to preparing for this.
All right, that's next week.
Yes. Oh, and so what I want to do, actually, the following Monday, let's record. Because
Okay.
what I'm going to do is this is a lot of good information. So I want to get a lot of good clips. So I'm going to build on this week and next week of these past two, really getting a lot of information to build up. And then we'll get back the following Monday to,
Okay. Yeah, no problem.
just to get some space in between.
Yeah, sure. We'll skip next week.
Yes.
It's a lot. I was thinking if we've done
Yeah.
this 7 times, that's like 3 or 4 hours worth.
Right. This is right. Right. This. Yeah. So that's why I was like, you know what? Let's put a space in there, because this
Okay.
is some. Yeah, I want to be able to clip it up and still on the process of being able to. It's so many different platforms. You have what audio is on SoundCloud. Then there's TuneIn, which is another podcast and like radio platform as well. So there are different platforms that is that I'm having it posted. So it's not just YouTube or Instagram. So it's different methods of, okay, how should this clip, be designed for this? So
Right.
yeah, this is some I'm sitting back just listening, and I'm like, wow, I'm grateful to hear all this information, because these are the conversations that are happening around us that impact our daily life. So
They do. They're very real. This is, I think, a lot of discussion around climate used to be considered way out there, forward thinking, and I see so much happening on the ground. It's impacting decisions that are being made right now.
Right.
And it's so I feel like it's very relevant, but it's still not very well understood. And so I appreciate you helping
We're getting there.
help get the awareness out there and help people understand it in little bits.
Yes. So thank you.
All right. Thank